You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Well, thanks very much. It's a real pleasure to be here and to see so many familiar faces. And I'll talk about research that's pretty topical on high-frequency trading and financial market design. At a very high level, I'm going to try to convince you that there's a structural flaw, a simple structural flaw in the way that our financial markets are designed. Before I get into the heart of the talk, though, I'm going to be talking a lot about milliseconds, microseconds. I want to start with thinking about time at a slightly higher level. Gary Becker was the first serious economist I ever read as an undergraduate. He wrote in his Nobel lecture, the most fundamental constraint is limited time. Time feels a little bit more infinite when you count in millionths of seconds, but time is nevertheless finite. He was a giant, and we all miss him. The theory of the allocation of time was, I think, the first serious piece of economics research I ever read as an undergraduate. My undergraduate thesis advisor, Walter Nicholson, for some reason said, "Oh, there's this economist, Gary Becker. You should read him. You'd like him." And here I am, many years later at Chicago. It's hard to put into words. With that said, let me get into my actual research, which is on high-frequency trading and financial market design. The motivation for this project is what looks like arms race activity among high-frequency trading firms, by which I mean investments of substantial sums of money in what look like economically trivial speed improvements. Let me start with my favorite example of the arms race. And this is actually the example that starts my paper, but also the Michael Lewis book. And he wrote it better, but I'll do my best. In 2010, a company called Spread Networks invested $300 million to dig a high-speed fiber optic cable connecting financial markets in New York City to financial markets in Chicago. And the salient feature of this cable is it was dug in a relatively straight line. And the straightness of this line shaved round-trip data transmission time by 3 milliseconds, by 3,000ths of a second. So to put that in context, blinking your eye takes several hundred milliseconds. We've been working on this project for over 3.5 years, which is in excess of 100 billion milliseconds. So 3 milliseconds doesn't sound like much. Industry observers described it as an eternity. The joke at the time was that the next innovation would be to dig a tunnel, so go through the Earth rather than around the Earth, because that would further shave data transmission time. And this joke actually materialized. Spread's cable is already obsolete. So it's not a tunnel through the Earth, but because light travels faster through air than through fiber optic cable, and this really special relativity that we're talking about, microwaves have further shaved data transmission time, and we're now down to 8.5 milliseconds. The Einstein bound is 8 milliseconds round trip between these two markets. And there are analogous races occurring throughout our financial system, sometimes measured as finely as millionths or even billionths of seconds. And in the last few months alone, the most recent innovation has been laser beams, which have the speed properties of microwaves but are more reliable in bad weather. There have been announcements to do with the release of public information early by firms like Business Wire. So it's a topic very much in the news. And we look at, in this project, we look at the arms race from the perspective of market design. It's an academic approach which takes for granted that participants in a market act rationally in their self-interest with respect to market rules, but takes seriously the possibility that the rules themselves are flawed. And I actually think this is a quite constructive approach to take to this, to the ongoing policy debate. It gets us around a lot of the moralizing about high-frequency trading. You'll see shouting on CNBC or in the press that has the flavor of, is HFT good or evil? And that's kind of a non-constructive question. HFTs are rationally optimizing with respect to market rules. The question is, are the market rules themselves optimal? So we're going to ask at a deeper level, what is it about market design that induces arms race-like behavior, and is this design optimal? And our central point is going to be that the arms race among high-frequency trading firms is a symptom of a simple structural flaw in market design. And this flaw is continuous time trading. So what continuous time trading means is it means you can trade, you can buy or sell stock or buy or sell futures contracts or buy or sell anything else at literally any instant during the trading day, where instant is measured as finely as computers allow. And what we're going to propose as an alternative is to make time discrete. So for trading to occur, instead of at literally any moment during the trading day, very frequently at discrete intervals throughout the trading day. So picture once per 100 milliseconds or once per second. And more specifically, we're going to propose replacing continuous time limit order book markets. Limit order books are the predominant market design used by financial exchanges today, with discrete time, what we call frequent batch auctions. So uniform price double auctions conducted very frequently in discrete time throughout the day. So it's a long paper and a long argument with 4 parts. I'm just going to go in, rather than giving you an outline of the argument up front, I'm just going to get into the substance of the argument. So the first thing I want to show you is some empirical evidence that continuous markets don't work as we expect them to, literally in continuous time, so at very high frequency time scales. So this is an illustration of the kind of data we're using. We have millisecond level, what's called direct feed data from the Chicago Mercantile Exchange and the New York Stock Exchange. So direct feed data is the data that high frequency trading firms subscribe to and parse in real time throughout the day. And this is an illustration of prices for the 2 most liquid securities that track the S&P 500 index. The E-mini futures contract that trades in Chicago on the Merc, and the S&P 500 ETF called SPIDER or SPY that trades in New York on the New York Stock Exchange and the various equities markets. And as you'd expect, given that both securities track the S&P 500 index, over the course of a day, the 2 prices are very highly correlated. This is what an hour of data looks like. This is what a minute of data looks like. And then this is what the data starts to look like when you zoom into high frequencies. This is a 250 millisecond slice of the day, or about half a blink of an eye. And what you see when you zoom into high frequency is that price relationships that look like they're moving in perfect lockstep, in fact, are moving in a much choppier fashion. So here's the price in Chicago jumping by more than a couple index points, and the price in New York doesn't react for many milliseconds. And similarly, here's the price in New York dropping by several index points, and the price in Chicago not reacting for many milliseconds. And there's 2 ways to quantify this phenomenon. One is just to ask, what is the correlation between these assets at different time horizons? At horizons of a few seconds or more, the correlation is essentially 1. They should be perfectly correlated. They track the same index. But at a millisecond, the correlation is less than 0.01. And it actually doesn't matter how you account for special relativity. If you take the perspective of a Chicago observer treating New York as the recent past, or a New York observer treating Chicago as the recent past, or if you just ignore special relativity altogether. So the correlation completely breaks down at high enough frequencies, 1. And then the second way to quantify this phenomenon is to ask, how often does this breakdown in pricing relationships create free money? Does it create technical arbitrage opportunities? So if you look here, at this moment, buying cheap in New York and selling expensive in Chicago is an essentially riskless profit opportunity. And we find that there are on the order of 800 such opportunities per day. But what I really want to show you is evidence on the time series of these opportunities. So let me get into that next. So our typical intuition about arbitrage, especially about really obvious arbitrage opportunities, like if the same security or almost the same security is trading in two different markets at two different prices, you should buy the cheap one and sell the expensive one. Our intuition about our obvious arbitrage opportunities is that they get competed away. And I'll show you some time series evidence that that's not quite what happens here. So the first thing is that we look at the duration of these technical arbitrage opportunities over the course of our data. Our data covers the period 2005 to 2011. And I should note parenthetically, this is a kind of a big data exercise. Each day has 23.4 million milliseconds. We have 7 years of all activity for these two securities, and then we have some other securities we analyze in the paper as well. So there's a lot of data with which we're doing very simple stuff, but it's a big data set. And so one of the things we're doing is we're asking every time the prices get dislocated, so the prices should move together, but let's say prices get out of whack and you can make money buying the cheap one, selling the expensive one. How big are these opportunities? How long do they last? So the first thing I'm going to show you is how long they last. The duration of these arbitrage opportunities has come way down over time. In 2005, they lasted on the order of 100 milliseconds on average. By 2011, it was sub 10 milliseconds, so less than 1/100th of a second. And this is a fancier way of showing the same thing. This shows you the distribution of arb opportunities by year. A way to read this figure is that if you were a 50 millisecond arbitrageur in 2005, that is, whenever prices were dislocated for at least 50 milliseconds, you could get that arbitrage. In 2005, you were state of the art and got almost everything. By 2011, you're completely obsolete and get essentially nothing. So durations have come way down over time, as we might expect. But profitability per arbitrage opportunity has actually remained relatively constant over time. And a way to think about this is what we're picking up is prices should move together. They actually move in a choppy fashion. There's nothing in market design that allows prices to move at exactly the same time. And the choppiness lasts less time as high-frequency traders have gotten faster and faster. But the kind of fundamental choppiness in this price path and this pricing process hasn't actually gone away. You still make just as much money per arbitrage opportunity at the end of our data as in the beginning of our data. The exception is you can see a little bit of a blip up during the financial crisis in 2008. A way to think about this is during the financial crisis, markets were just a lot choppier. And the bigger our price movements, the more common are really large price dislocations. So 2008 was actually the best year, I think, in history to be a high-frequency trader. Profits were lower pre-2008 and also lower post-2008. This is the frequency of arbitrage opportunities over time. Frequency does vary substantially over time, but it's explained almost perfectly by just asking how volatile was the market on a particular day. Again, the more choppy is the market, the more opportunities there are to buy low, sell high, because just prices get dislocated more. This is a complementary way of looking at the same phenomenon. What this picture shows is the correlation curve in each year of our data, where each of these curves is for each time interval from 1 millisecond up to 100 milliseconds, how high was the correlation between these two assets, these two S&P 500 securities. And if you look over here at 100 milliseconds, you see the correlation getting higher each year, 2005, 6, 7, up through 11. And that, in a sense, is remarkable technological progress. Right? Information is getting from Chicago prices into New York prices faster than ever, from New York prices into Chicago prices faster than ever. If you look here, though, at 1 millisecond, you see that in all years, at high enough frequency, correlations completely fall apart. And again, there's nothing in market design that allows security prices to move at exactly the same time. So these results suggest that we should view the arms race as something of a constant of the market design, rather than as a profit opportunity that gets competed away over time. So these correlation curves show that competition over time, so the high-frequency trading speed race, has increased the speed with which information makes it from one securities price into another securities price, but does not eliminate the underlying phenomenon that prices can't move at exactly the same time. Correlations break down at high enough frequency. And then the technical arbitrage analysis, a way to interpret that is that competition does increase the speed requirements for capturing arbitrage opportunities. It, quote, raises the bar, but competition can't eliminate the arb opportunity altogether. It doesn't reduce their size, and it doesn't affect their frequency. Frequency is affected by volatility, but not by speed competition per se. And these are facts that we're going to take to inform and then also explain with our theoretical model. So we think this one trade is on the order of $75 million a year. So counting up every time prices are dislocated, how much money do you make buying the cheap one, selling the expensive one, accounting for transactions costs and adding up overall the quantity in the book, it adds up to about $75 million a year. We actually think this number is a slight underestimate, but the details for that are in the paper. The thing I really would like to emphasize is that this is just the tip of the iceberg in the race for speed. There's hundreds of pairs of securities that are very similar to this S&P 500 pair, so highly correlated, highly liquid. In fragmented equity markets, there are even simpler trading opportunities. You can take the same stock trades on 13 different exchanges and 50 different dark pools. So all of those prices should move exactly together, but nothing in market structure allows them to move at exactly the same time, and you can make money buying the cheap and selling the expensive one. That, in a sense, is the heart of the Michael Lewis book, these kinds of arbitrage opportunities. Correlations that are high but far from one can be exploited in a statistical sense. There's a race to get to the top of the book, which is an artifact of fat tick sizes. So this shows up in a lot of contracts that trade on the Chicago Mercantile Exchange, which has fat ticks. Interestingly, there's a discussion in Washington about mandating a larger tick size in U.S. equities with a theory that somehow that will invigorate the market for small cap stocks and equity research. The argument doesn't make a whole lot of sense, but from a high frequency perspective, widening the tick size just exacerbates the race to get to the top of the book. And then there's a race to respond to public news events, like when there's a Fed announcement at 2 p.m., there's a race to react, or when the Michigan consumer confidence number comes out at 10 a.m., there's a race to react. And you can think of this aspect of the race as what's been motivating a lot of the New York Attorney General's inquiry into high-frequency trading practices. We're not going to try to put a precise estimate on the total prize in the race, but common sense suggests there's a lot of money on the line. So I now want to use these empirical facts to motivate a theory model. And the theory model is going to do two things. It's going to be a critique of continuous trading, and it's going to help us articulate what exactly is wrong with competition based on speed. What exactly are the economic consequences of this race for speed? So it's a very simple new model, which tries to explain the facts and then serves these two related purposes. And I'm going to go through it in some detail. And this is a bit more mathematical than the rest of the paper, but bear with me. I actually think at core it's a very simple model and makes important points. So there's a security, call it X, that trades on a continuous time market, a continuous limit order book market. There's a publicly observable signal, call it Y, of the value of security X. And we're going to make a purposefully very strong assumption, which is that this security X is perfectly correlated to this public signal Y. And moreover, at any moment in time, you can cautiously liquidate X and get Y. So what we're trying to do is set up a best case scenario for price discovery and liquidity provision in a continuous time market. We're trying to set up a model in which it should be economically trivial to provide liquidity in the market for X, and then I'll show you that it's not because of the market design. In particular, this model doesn't have asymmetric information, it doesn't have inventory costs, it doesn't have the usual sources of costly liquidity provision. And you should think of X and Y as a metaphor for pairs of securities that are highly correlated. So think of X as the SPDR, S&P 500 ETF, and Y as the E-mini future S&P 500 contract that trades in Chicago. Or think of X as Chipotle stock on the New York Stock Exchange, and Y as Chipotle stock on the BATS exchange or the NASDAQ exchange. So this signal Y evolves as what's called a compound Poisson jump process. This is just a fancy way of saying there's this public signal Y, and from time to time it jumps around. And there's the rate at which jumps arrive is called lambda jump. And then the size of the jumps is denoted by big J. So big J is the distribution. Think of it as how often does the market go up 1 tick? How often, with what probability when the market moves does it go up 2 ticks? With what probability? 3 ticks. Think of that as what big J is telling you. There's 2 types of participants in our model, investors and trading firms. Investors represent end users of financial markets, so mutual funds, pension funds, hedge funds, et cetera. And they're going to be very simple in our analysis. They just arrive randomly to market needing to buy or sell 1 unit of the security X. They have a random arrival rate, lambda invest. It's equally likely that they need to buy a unit versus sell a unit. They're very mechanical. Okay? And they're just going to trade at market immediately upon arrival. The other kinds of participants in our model are trading firms, or equivalently high-frequency traders, algorithmic traders, et cetera. They don't have an intrinsic demand to buy or sell X. They're traders. They want to buy low and sell high, and their goal is to maximize profits per unit time. Initially, I'm going to treat the number of trading firms as exogenous. There's just capital N trading firms present in the market. And then later, I'll endogenize entry, so allow for costly entry by investing in a speed technology. Okay, so I'm going to think about latency at first in a very simple and stylized way, again, towards building up a best case for the performance of a continuous market. Initially, there's no latency in observing Y. So whenever this signal Y jumps around, everybody in the game sees it immediately for free. And moreover, there's no latency in submitting orders to the exchange. So if I decide at some time that I want to send an order to the exchange to buy, my order reaches the exchange at exactly that time. If my order to buy and your order to buy reach the exchange at exactly the same time, the exchange processes these 2 requests one at a time. This is called serial processing, S-E-R-I-A-L, not like the breakfast cereal. And that's going to contrast with batch processing, which is part of what we're going to propose. Okay? And again, we're trying to build a best case scenario for continuous trading. Part of that best case scenario is assuming away latency. Okay? So given this model setup, there's no asymmetric information, there's no inventory costs, everybody's risk neutral. You might think that competition is going to lead to a really healthy outcome, which is it should be very easy, should be economically trivial to provide liquidity in the market for X. But that's not what happens in a continuous limit order book due to a phenomenon we call sniping. Okay? So suppose this signal Y jumps. So it jumps from Y lower bar to Y upper bar. So the price in Chicago of the E-mini future goes up 2 ticks. So this is the moment at which the correlation between Y and X temporarily breaks down. Okay? So if I'm a trading firm providing liquidity in the market for X, what am I going to do? I'm going to say, well, I was providing quotes here based on the old level of Y. The world changed. The market just jumped a couple ticks. My quotes are now incorrect. They're stale. I'd like to cancel these quotes. So I'm going to send a message to cancel my old quotes and replace them with new quotes based on the new public information. But at the exact same time, other trading firms are going to try to snipe my stale quotes. So the world changes. I send a message to cancel these quotes. At the exact same time, all of you, the other trading firms, send a message to buy at my ask price. So this is my bid, this is my ask. My ask is too low relative to the new information. All of you try to pick off my stale ask price. And since continuous markets process these requests in serial, so one at a time in order of arrival, it's possible that one of your requests to trade at this old price is going to reach the exchange before my request to cancel these quotes and replace them with new quotes based on the new information. And it's actually not only possible, but probable, because there's one of me trying to cancel, and everybody else is going to try to exploit my stale quotes. It's kind of an asymmetry. So when there's a big jump, liquidity providers get sniped with high probability, with probability n-1 over n. So if there's 100 trading firms, it's a 99 out of 100 chance that you get sniped when there's a big jump. So in a continuous market, symmetrically observed public information, these jumps in y, create technical arbitrage opportunities. Everybody in this room understands equally well that x is worth y. Y jumps, we all see it at exactly the same time, and yet somebody's going to make money from being the first message processed to trade at my old price. Okay? This is not supposed to exist in an efficient market. There shouldn't be such simple arbitrage opportunities in a properly designed market. And it's closely associated with that correlation breakdown phenomenon that I showed you on the first few slides. And the reason this matters is that in equilibrium, the cost to me of getting picked off by all of you is something I'm going to have to pass on to investors. It's a cost of doing business. It's a cost of liquidity provision. So if you then take that insight and work through what does equilibrium look like, and I'll go through these couple of slides pretty quickly, you get an equilibrium in which of the n trading firms, one of them provides liquidity to real investors, provides bids and asks, and the other n-1 of them lurk in the background, and whenever there's a big jump, try to pick off stale quotes. So call that liquidity provider, and then stale quote snipers. Trading firms are going to be indifferent between these two roles in equilibrium, and in practice, most of the high-frequency trading firms I've spoken with perform both roles interchangeably throughout the day. There are some exceptions to that. So in equilibrium, the bid-ask spread I have to charge as a liquidity provider, so the difference between the price at which I'm willing to buy and the price at which I'm willing to sell, is going to have to compensate me for the risk of getting picked off by all of you. And if you work through the math, you get an equation that describes the bid-ask spread, which creates revenue for me from investors. Investors come along and pay me my bid-ask spread. That's good news for me as a liquidity provider. And that compensates me for the risk of getting sniped by all of you. And there's a nice economic interpretation. On the left-hand side of this equation is the revenue from investors due to a non-zero bid-ask spread. On the right-hand side of this equation is the rents to trading firms from this technical arbitrage that's caused by the market design. Okay, so what happens if, so far investors show up wanting to buy or sell one unit? It's a very stylized model. What happens if investors show up wanting to buy or sell 2 units, or wanting to buy or sell 1 million shares? Well, if I'm a liquidity provider and I provide a really deep book, I provide 1 million shares at the bid and 1 million shares at the ask, and there's a jump, you're all going to try to pick me off for all 1 million shares, because it's free money for all of you times 1 million. Okay? So the costs of providing a deep book scale linearly with how deep of a book I provide. But the benefits of providing a deep book, not all investors want to buy or sell 1 million shares. Many want to buy or sell just 100 shares. So the benefits of providing a deep book don't scale. So this cost, this sniping cost, causes not only there to be a non-zero bid-ask spread, even without asymmetric information, inventory costs, any of that, it also causes markets to be unnecessarily thin. I'm not going to be able to provide a 1 million share book, or rather I'm going to have to charge an extremely large price for quoting that much depth because I'm worried about getting picked off. So the next thing we do in the model is endogenize entries. So far it's free to observe innovations in Y, and there's just some exogenous number of trading firms. There's 100 trading firms in the market. Now there's a simple tweak to the model, which is that now everybody can observe innovations in Y at slow latency for free, at latency of delta slow. Or you can pay a cost, a speed cost, to observe innovations in Y faster, so delta fast. So think of this as going from the slow cable to the spread networks cable. We're going from the spread networks cable to microwaves, or from 2012 microwaves to 2014 microwaves. In equilibrium, we get a very similar structure to above. There's a liquidity provider, everybody else snipes. Fast traders are indifferent between the two roles. And when you work through the math, I'm going to skip these equations, you get a really nice characterization of equilibrium where the total revenue from investors that the liquidity provider earns equals the total expenditure on speed by high-frequency trading firms. So think of it this way. Continuous trading creates these technical arbitrage opportunities, creates a pie of, say, $20 billion a year. And then high-frequency trading firms invest real resources, so build $300 million cables trying to get at this pie. And in equilibrium of our model, all of the rents from these technical arbitrage opportunities get soaked up, get dissipated in competition to realize the arbitrages. So there's an equivalence in our model between the prize in the speed race, the amount expended on the speed race, and the end cost to real investors. And you should always keep in mind, it sounds like sniping is just HFT on HFT combat. But you should always keep in mind that profits in financial markets have to come from somewhere. You should always ask, where are they coming from? In our model, they're coming from end investors. So it's a Chicago audience. I'm a Chicago guy. I have to ask the question, isn't what I'm calling an arms race just healthy competition? What exactly is the market failure? And our model points to two market failures. One is this phenomenon we call sniping. Technical arbitrage opportunities are simply built into the continuous limit order book market design. And these are opportunities that should not exist in an efficient market and allow you to earn rents from symmetrically observed public information. So we all have an intuition that if you're a hedge fund analyst and you figure out something about a company that nobody else in the market knows, you can make money from that. But in this model, you figure out something that the rest of the market knows, you can make money from that. So symmetrically observed public information you can make money from. And then the second market failure is that this free money creates a speed race. And mathematically, for those of you who have taken CompStrat, this is a prisoner's dilemma. A couple other remarks about the model. One is that the arms race in our model is a constant. So nothing in our analysis depends on whether the difference between fast traders and slow traders is seconds or milliseconds or microseconds or nanoseconds. Instead, this sniping phenomenon is an equilibrium feature of continuous trading. It doesn't get competed away. And this ties nicely with the empirics that I showed you. A second remark is our model encourages, I think, a constructive way of thinking about high-frequency trading firms. In our model, HFTs endogenously decide to perform two roles, a useful role and a negative role. The useful role is providing liquidity and enhancing price discovery for real investors. So Y is jumping around, I'm providing liquidity in the market for X. That's a useful, valuable function. The negative role is sniping stale quotes. When the market changes, picking off old prices. This sniping stale quotes looks like zero-sum HFT on HFT combat, but in equilibrium it gets passed on to real investors. And our proposal, frequent batch auctions, preserves the useful function, the price discovery and liquidity provision, but eliminates the rent-seeking function. One last remark is, what I'm saying about the arms race and its negative effect on liquidity might seem in tension with the fact that markets today are more liquid than they were in the pre-HFT era. So just common sense, if you traded stocks in the 90s and you traded stocks in 2014, it's a lot cheaper in 2014 than it was in the 90s. But if you look at the data, there was a huge information technology revolution as financial markets switched from humans to electronic-based. And if you look at the data, all of the gains were realized in the relatively early stages of that IT revolution. So this is my favorite way of showing this. This is data from the high-frequency trading firm Virtu's S1 filing, so their IPO prospectus. And they named this figure narrowing bid-ask spreads, and they show that from 2003 to 2013, bid-ask spreads came down 35%. But if you actually look at their data, all of the gains were 2003 to 2007, and then it's actually flatlined or even slightly up since 2007. So my takeaway from the empirical record is that IT, information technology, has been unambiguously good for markets. But the speed race, there's no evidence that the speed race has been good for markets. And our research suggests that the speed race has been negative, at least in these recent years at millisecond and microsecond level. So I now want to spend the last, say, 10 or so minutes of my talk, and then I'll take time for questions, describing an alternative to continuous trading, which we call frequent batch auctions. So at a high level, frequent batch auctions are very analogous to current practice, to continuous limit order book trading, with the key exception that instead of continuous time, being able to trade at literally any instant, time is discrete. So you can trade once per tenth of a second. Just by continuous versus discrete time, as an analogy, think about tick sizes, right? Stocks trade in pennies. That's a discrete price increment. I'm not allowed to bid a millionth of a penny more than you to jump ahead of you in the queue. We have a discrete price increment. And in a sense, what we're proposing is a discrete time increment. Discrete time then necessitates what's called batch processing. So it's possible, once you go from continuous time to discrete time, it's possible that many requests to trade will arrive at the same time, in the same 100 milliseconds. And these have to be processed all together, processed in a batch rather than one at a time. And the natural way to do this is using an auction. Okay? So a little bit more concretely, our proposal is divide the day into equal length intervals, say 100 milliseconds. During this interval, traders submit bids and asks, same language as currently, a price, quantity, and a direction. Orders can be freely canceled, withdrawn, modified at any moment in time. And at the end of each interval, the exchange batches together all of the outstanding orders and computes market level supply and demand curves. There's two cases. Supply and demand either don't cross or they do. If they don't cross, then there's no trade. All orders remain outstanding for the next batch interval. And you should think of this case, let me just show you a picture. So here's the no trade case. Here's a demand curve, so a bid here, a bid here, a bid here, a bid here, and a supply curve. There's an ask, there's another ask, etc. Think of this case as analogous to what a continuous limit order book looks like in the current design. Most stocks in most seconds have no trading activity. Instead, what you see as a market participant is supply and demand. I can buy here, or I can sell here. And that's exactly what discrete time auctions look like in the case where there's no trading activity. The other case is that supply and demand do cross at some price, call it P star, in which case the logic is one of a uniform price auction. This is actually originally proposed by Milton Friedman in the 60s and adopted in the 90s by the US Treasury for US Treasury market auctions. But I'll describe it here in the context of stocks. So if I bid more than P star, let's say P star is $10. If I bid 10.01 or higher, or I ask 9.99 or lower, I transact my full quantity at P star at $10. That's the uniform price aspect of the auction. If I bid exactly $10, I might get rationed. I'll show you that on the next slide. And then the suggested rationing rule is to respect time priority, but treating time as discrete. So if my order has been sitting in the book for 10 seconds and your order is new to the book in this particular trading interval, my order has precedence over yours. But if my order and your order reach the exchange at the same interval, but mine reached the exchange a microsecond before yours, we're treated equally and there's just random rationing called pro rata. Okay? So this is what this case looks like. You can think of, here's the market. The market's flashing over and over again every 100 milliseconds like this. And then in this particular slice of 100 milliseconds, some people show up wanting to buy. So here somebody wants to buy here, and here somebody wants to buy here. The market clears it at price P star. So I want you actually to think of the auction as very similar to continuous limit order book trading. The biggest difference, though, is if there's a surge of new activity in a 100 millisecond slice of the day. And that's likely trading algorithms responding to some piece of information. And I'll describe on the next few slides why it's valuable to use an auction. The last point about the auction design is after the auction's computed, announce the price, the quantity, the supply and demand curves, and there's some more details about our information policy below. So why is this a good idea? Why are frequent batch auctions an attractive alternative to continuous trading? Well, there's two reasons, the first of which is kind of obvious and the second of which is more subtle. So the obvious reason is that frequent batching reduces the value of a tiny speed advantage. If I'm 100 microseconds faster than you, in the continuous market, whenever there's a jump in Y, I get there first. Whenever there's a race, I win the race. Whereas in the discrete market, let's say the market's trading once per second, and I'm 100 millionths of a second faster than you, there'll be some tiny slice of the second where if something happens, I can react and you can't. But most things that happen in the second, you and I either both have plenty of time to react or neither of us can react in time. The second and more subtle reason why frequent batching is attractive is that it transforms competition on speed into competition on price and eliminates the sniping phenomenon I described earlier. So suppose I'm trying to provide liquidity and there's a jump in this public signal Y. So the E-mini jumps or Bernanke or Janet Yellen makes an announcement at 2 p.m. that is obvious. It's obvious to all participants that the market's going to tick up several points. In the continuous market, there's a race to pick off stale quotes at these incorrect prices. In the batch market, there's an auction. There's a competition to figure out who's going to get to trade given this new information. And in that 100 millisecond interval, there's plenty of time for competition to occur. So for an inequilibrium, competition bids the price up to the new correct level. So if there's symmetrically observed public information, the market was at 10 bucks, there's some news event that makes it obvious to everybody in this room that the market should now be at $10.10, well, then competitive forces are going to bid the market up to $10.10. If there's asymmetric information, the rest of the market thinks the market should be at 10.10, and you uniquely know that the market should be at 10.20, the news is even better than the rest of the market appreciates, you can make money. You'll be the one who gets to buy, you'll pay 10.11, and you'll be able to make a rent. So competition, pure speed competition is designed away. Competition is instead based on price, who's willing to pay the most, or smarts, who knows something that the rest of the market genuinely doesn't know. So in equilibrium, the benefits of frequent batching relative to continuous trading are it eliminates sniping, which enhances liquidity, so narrower bid-ask spreads and greater depth, and it stops a socially wasteful arms race. The cost is that investors have to wait to transact. We can debate whether waiting 100 milliseconds to transact is a big cost or a little cost. And we can also debate what other kinds of costs might emerge from going from continuous trading to discrete trading that are outside the model. Make a few other remarks. So the equilibrium analysis focuses on liquidity in a socially wasteful arms race. Another case for discrete time trading is based on computational advantages. So continuous time trading implicitly assumes that computers and communications technology are infinitely fast. If an event happens on bats, the NASDAQ knows about that event immediately. So if you've read the Michael Lewis book and have heard of the SIP feed, the Securities Information Processor, and the discrepancies between SIP feeds and direct feeds, or if you tried to read about that and your head exploded, all of this is a manifestation of the fact that information doesn't travel instantaneously fast. It takes, in that case, a few hundred microseconds or a couple of milliseconds to get from one place to the other. Discrete time respects these computational and communications limits. You can think of this as having a few different types of benefits. As an algorithmic trader, discrete time means I see what happened in the market at time t. I have a block of time to think about it, or for my algorithm to think about it, and make decisions at t+1. I then see what happened at t+1, have a block of time to think about it, make decisions at t+2. So for those of you who have done any programming, that's a very clean programming environment. Whereas in the continuous market, you don't know what you're going to learn when, and you also don't know what information others in the market have. And what information you have is already stale because something happened within kind of the event horizon of your latency with respect to the market. For exchanges, continuous trading creates a computationally impossible task. Exchanges invariably get backlogged. If there's a lot of activity, it takes time to process that activity. In discrete time, the computation is trivial. I had a research assistant, an undergrad, program batch auctions on his laptop using the amount of message activity during the flash crash. And again, a research assistant on a laptop, it was under 10 milliseconds. So it's not instantaneous. It doesn't take zero. Nothing takes zero. But it's computationally very simple. The Facebook IPO debacle was kind of the combination of this issue and a coding bug. But the NASDAQ was kind of a few milliseconds off and where it thought, it's not worth getting into, but it was kind of the combination of this issue and then exacerbated by just a bug. As a regulator in continuous market, it's difficult to parse the audit trail. You don't know exactly what happened in what order across markets. It took months for regulators to figure out what triggered the flash crash. And even today, our understanding of that day's events are far from complete. Whereas discrete time yields a simple audit trail. Stuff happens at t plus 1. Once per 100 milliseconds is very different in terms of the audit trail it yields from once per nanosecond. And nanoseconds too fine relative to just noise and communications and computing time. There have been multiple other policy responses to the high-frequency arms race. There's what's called a Tobin tax, message-to-trade ratios, minimum resting times. You can use our model to analyze many of these alternative proposals and really criticize many of these alternative proposals. I think many of them come from the view that high-frequency trading is evil and we should try to ban it, rather than taking a deeper structural approach and thinking, what is it about market design that's incentivizing arms race behavior, and is the market design optimal? An exception is IEX, kind of the heroes of the Michael Lewis book. Their market design, which consists of a speed bump and price sliding. I won't get into the details just in the interest of time, but feel free to ask if you're interested. Actually does eliminate what we call sniping, but it only works to the extent that IEX is small. So while price discovery happens on BATS and NASDAQ and the New York Stock Exchange, and IEX can, in a sense, free ride off of that price discovery happening elsewhere. There's many open questions in our research. We haven't attempted to characterize the optimal batch interval. We haven't analyzed competition between exchanges. So what happens if NASDAQ decides to move to discrete time auctions tomorrow, but New York Stock Exchange stays continuous? There's numerous other open questions, but it's one paper. I'm hacking at as much of the problem as I can. We're looking at, just to summarize, we look at the arms race from the perspective of market design. We don't think the root problem is evil high-frequency trading firms. It's flawed market design, continuous time serial process trading. And as an alternative, we propose discrete time batch process trading. So just to rehash the argument, first of all, continuous time markets are a fiction. Correlations break down, and there are frequent technical arbitrage opportunities. Second, these technical arbitrage opportunities induce a never-ending speed race, which looks like a constant of the design. The bar keeps getting higher each year, but it's not competed away. Our theory model shows that the root cause is market design, is continuous limited order book trading. Arms race is an equilibrium feature of the design and harms liquidity and is socially wasteful. And then we show that frequent batch auctions is an attractive market design response. An equilibrium, and it eliminates sniping, it stops the arms race, and enhances liquidity, and more informally, we think it has computational advantages. The costs are that investors have to wait to trade. There's potential unintended consequences, although I'd also mention that the continuous market has itself had numerous unintended consequences, and that's part of why the high-frequency trading debate is so active today. So let me stop there, and I'm happy to take questions for as long as you've got them.
There are two important parameters now rather than one, tick size in time and tick size in price. Can you speak about how a regulator or exchange owner would optimally choose those parameters?
That's a really good question. So our model actually assumes away the tick size and price. It kind of treats the tick size and price as being arbitrarily fine. And I actually think in discrete time auctions, there's less of a need to have a discrete tick. Part of the reason you want a discrete tick in continuous markets is I bid 1001, and then a microsecond later you bid 1001 and a millionth of a penny. And then a microsecond after that, I bid 1001 and 2 millionths of a penny. So there's this explosion in message traffic that's economically meaningless, where millions of pennies don't add up to much. So there's a clear need to have a discrete tick size in continuous markets. There isn't a canonical economic model of what the optimal tick size is. I think if you asked most of the folks in this building, most people would agree that the optimal tick size is not 0. But if you pushed on should it be a penny or should it be a nickel or should it be a dime, I don't think we have a really firm theoretical intuition on what it should be, other than to say that it should probably be proportional to the size of the dollar price of the stock rather than absolute. So a penny tick size for Google stock, which is $500 or $600 a share, is very different from a penny tick size for Bank of America stock, which is, I don't know what it's trading at today, but for a while was, or Citigroup was for a while like $3 or $4 a share. So there a penny is huge. So the way I think about our paper is it's going from continuous time to discrete time, holding tick size issues constant. If anything, discrete time lets you choose a finer tick size, which means more accurate price discovery, although how fine, I don't really have a really concrete way of thinking about it. It's a great question.
So you mentioned that there was a certain millisecond delay in terms of transmitting information from, say, two cities. How does that compare to the latency and actually computational delays? So, how long does it take to actually process the information? And does the format that the information comes in matter, specifically around like announcement information?
That's a great question. So there are several different sources of small latency. So there's how long. One of the sources of latency is just Einstein stuff. There's a minimum time it takes for information to travel a distance. So NASDAQ servers and New York Stock Exchange's servers are 20 miles apart. If you do the Einstein math, it's like 100 microseconds or whatever the number turns out to be. And then it takes more than that because we're not quite at the speed of light. Think of it as it takes some time for information to get on the line and then off the line. How long it takes to compute stuff depends on how complicated is the stuff you're computing. So really simple computations like, is the price of the S&P 500 different in Chicago versus New York? That's a few computing cycles. And if you have you've heard of a chip being 3-point-something gigahertz, that means 3-point-something billion cycles per second. So a lot of the simple stuff is really fast. Complicated stuff is much longer than a second, right? Some computer tasks take weeks, and there'll always be a incentive to speed up those kinds of computing tasks. I think the way I like to think about what discrete time means is it's long relative to the differences in speed last year versus this year, the latency caused by special relativity. So the interval should be a long time for a computer, but still really fast. But we don't have a precise formula that says the interval should be 57 milliseconds.
So you mentioned this earlier. Can you speak a little bit to the flaws of IEX, which doesn't go the whole way to making frequent batch auction, but only delaying the market pricing data and the trade orders?
Yeah, so I think IEX is kind of ingenious, and I admire the guys at IEX a lot. If you read the Michael Lewis book, there's a page about a stream of professors that visited the IEX offices, and I'm proud to say I'm part of that stream, although they didn't. I think I caught them too late to really persuade them about the virtues of discrete time. They were already pretty far down the path they've taken. And they did not know at the time that Michael Lewis was writing a book about them. They found this out in like December. way after he'd interviewed them. But IEX does, the way to think about it is it's really the combination of two features. They have a speed bump of 350 millionths of a second, 350 microseconds. And this is the thing, if you saw the 60 Minutes piece, this is that cable that like shoots around in a circle. And that speed bump means, let's say I'm providing liquidity in Chipotle stock, and Chipotle stock jumps on bats. The speed bump means it takes me 350 microseconds to cancel my quotes, and it takes you 350 microseconds to pick off my quotes. So the speed bump on its own doesn't really accomplish anything. All the speed bump does is delays actions by 350 microseconds. But the second feature of their design is what's called price sliding. So if the Chipotle price on bats jumps up to here, so IEX is at $10, bats jumps up to $10.10, IEX detects in 200 microseconds, in 200 millionths of a second, that the price on the rest of the market has changed. And they then have logic in their market rules that says you're not allowed to price more aggressively than the midpoint of the rest of the market. So if the midpoint of the bats exchange is $10.10, and I have an ask down here at 10:01, IEX's logic says this quote is no longer valid. It gets automatically slid up to the new correct level. And that only takes 200 microseconds to do. They've got fast connections to all of the different exchanges, all of which are in server farms in New Jersey. So as long as the price discovery is happening on bats, or really happening on the rest of the lit market, bats, New York Stock Exchange, NASDAQ, IEX can use this combination of the speed bump of 350 millionths of a second and this 200 microsecond connections to the other exchanges to protect quotes from getting sniped. So that's the ingenious part. The limitation is that that works great while they're currently 0.5% of the market. So price discovery really is happening elsewhere. If they were 100% of the market, then they would just be a continuous market with an annoying 350 microsecond delay that doesn't actually solve the underlying problem. And where in between they start to hit trouble is an open question. So if I were them, what I would do is use their current design to get off the ground. And then once they get big, I would pivot to frequent batch auctions. We'll see if they listen to me. But that's what I would do if I were them. Well, I'm happy to take further questions offline. I have a feeling this topic will be topical for a while. Milton Friedman had this great line. He said, it's really hard to change policy. There's enormous inertia in the private sector, and especially regulatory arrangements. There's an inertia of the status quo. And it's only upon a crisis that there's real change. And he said, our job as economists is to develop good ideas and then to keep them active, keep them part of the public discussion so that when a crisis hits, people reach for a good idea rather than reaching for a lousy idea. And I don't know if the Michael Lewis book is a crisis. We'll find out. Let me stop there.